Welcome to this explainer. Okay, so if you've ever spent more than 5 minutes scrolling through social media, you've definitely seen people hyping up buying the dip or throwing around massive company names like Tesla. There is just so much buzz and excitement out there about the market right now. And honestly, you've probably felt a little FOMO, the fear of missing out, hearing all those terms flying around. But let's pause for a second. Have you ever stopped to wonder what people are actually buying when they talk about stocks? Like, what's the actual mechanism happening behind the scenes? Well, let's dive right into it. Here's our roadmap for today's explainer. We're going to cover what a stock is, how businesses get funded, where to actually buy stocks, the difference between common and preferred stock, and finally, why you should even bother investing your money in the first place. All right, section 1. What is a stock? Let's start right at the foundation. Simply put, a stock is literally a tiny piece of ownership in a business. That's it. When you buy a stock, you aren't just trading abstract numbers or playing with some random ticker symbol on a screen. You literally own a sliver of a real-world company. It's actual, literal ownership. Think of it like this. Imagine your absolute favorite streaming service is a giant pie cut into equal slices, or shares. If that entire company was divided into just 10 slices total, and you bought 5 of them, boom, you literally own half of that entire company. Now, sure, in the real world, massive companies have millions of shares, so your percentage is going to be way smaller, but the core concept, exactly the same. Moving on to section 2, funding a business. Why on earth would a company sell pieces of itself to random people instead of just, going to a bank? Well, creating and growing a business is incredibly expensive. Let's look at an example. Imagine a woman named Maya who wants to open her dream sneaker store called Fresh Kicks. She's crunched the numbers, and she needs exactly $100,000 to get the doors open. The catch? She only has $50,000 saved up. Now, instead of taking out a massive, soul-crushing bank loan with heavy interest, Maya does something really smart. She divides her business into 10 equal shares of 10 grand each. Because she's putting in her own $50,000, she keeps 5 shares. Then, a local sneakerhead named Jordan hears the pitch, thinks it's a real game changer, and buys 1 share for $10,000. Maya gets her cash totally debt-free, and Jordan, he now owns a solid 10% of Fresh Kicks. Let's fast forward 5 years. Fresh Kicks is absolutely crushing it. Maya just opened 3 more locations, and the business that started out at $100,000 is now valued at $300,000. And remember Jordan? His 10% ownership, which he bought for 10 grand, is now worth $30,000. If he decides to sell his slice today, he walks away with a cool $20,000 profit. That right there is the power of business growth. But hey, let's keep it real. Investing isn't always a guaranteed success story. What if Fresh Kicks completely struggled to compete with massive online retailers? If the business's overall value dropped from $100,000 down to $80,000, Jordan's 10% share drops right along with it. It would only be worth $8,000 now, leaving him with a $2,000 loss. This is exactly how the stock market works in the real world, just on a much, much larger scale. Now, aside from the stock price just going up or down, there's actually another way you can make money. Some companies reward you directly by paying out what are called dividends. Basically, think of a dividend as getting a literal slice of the company's profits sent straight to your pocket, just as a thank you for being a part owner. Pretty nice, right? Okay, section 3, where to buy stocks. So if you actually want to become a part owner in a business, like Fresh Kicks, where do you go shopping for these company slices? When a company gets big enough, let's say Fresh Kicks becomes a national chain, it might decide to go public. All that means is they list their shares on a stock exchange. Think of stock exchanges like these massive, bustling, global marketplaces where people buy and sell shares. The heavy hitters are the New York Stock Exchange, or NYSE, and the NASDAQ. And the best part? Today, you don't need to physically travel to Wall Street in a suit to participate. You can access the whole shebang right from an investing app on your smartphone. Section 4, common versus preferred stock. When companies issue these stocks, they typically come in 2 main flavors. Think of them kind of like regular and VIP concert tickets. Common stock gets you actual voting rights on big company decisions and offers high potential growth, but you are absolutely last in line to get any money back if they go bankrupt. Now, preferred stock is like the VIP pass. You usually give up your voting rights, but in exchange, you get guaranteed steady dividends. Basically, it's a choice between maximum growth with a little drama or steady security with far less risk. Which brings us to section 5. Why invest your money? With all the risks and roller coasters we just talked about, why not just keep your cash perfectly safe in a bank? Well, it all comes down to potential growth. Keeping your money stuffed in a traditional bank account might earn you a very, very safe 1 to 2% in interest every year. But get this, historically, the stock market has returned an average of 7 to 10% per year over the long haul. Yes, you have to deal with the risk of that roller coaster ride, but over many years, that huge difference in percentage is exactly how long-term wealth is actually built. So, the absolute main takeaway for this explainer is to remember that investing is not just some flashy casino of green and red numbers on a screen. You are buying actual ownership in a real business. If you're just starting out, look at companies you actually understand and believe in. And crucially, whatever you do, don't dump all your money into just one single stock. Like the old saying goes, don't put all your eggs in one basket. Diversify your investments to protect yourself from the downside. We've built a really strong foundation today on how wealth building actually operates under the hood. So here is the million-dollar question for you to chew on. Are you going to spend the rest of your life just handing your money over as a consumer of these massive companies, or are you finally ready to step up and become an owner? Let us know what complex financial topic you want us to demystify next. Keep learning, keep exploring, and I'll catch you in the next explainer.